Hey everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and a best-selling international author of Australian Real Estate Investing Made Simple. Welcome to the December 2025 Melbourne Property Market Update. And it's all happening. Investors are back. There's record low volume of stock being created on the market. The interest rates cuts have ceased. Inflation is higher. Auction clear rates are slightly up in some areas. Some areas are suffering, but it's definitely all happening in Melbourne. I'm going to unpack this and many other topics. So sit back and relax, grab a coffee, grab a V drink, and I'm going to talk about the implications of what's happening in the Melbourne property market in the last few months and what smart investors are doing to take advantage of the prevailing circumstances. So welcome to today's video. Now, before we get started, by the way, just want to do a bit of a disclaimer. The information that I'm sharing with you today is purely educational purposes only. I'm not here to give you any financial advice. Before you seek any financial advice, speak to someone that's qualified. And the most important thing is to have the results that you want to achieve. Then they're not just a broke academic, which is pretty much the entire industry. A bit about myself before we get started. Obviously, in my YouTube channel, I've wasted 4 years at Monash University, drinking beer at the tavern and shooting pool. Nearly did an MBA, more bad advice, but I left. I've got a real estate background. Before then, I was in mortgage broking, private banking, and after I finished my degree, I was in financial planning, working for Australian Unity Funds Management. The most important thing is, guys, that I'm a property investor myself in Melbourne. I'm just nearly 50. I've been investing in property for decades. I've been obsessed with property investing since I was 18. So 30 years plus in the industry. I've seen the market go up, down, and sideways. I've experienced multiple property cycles. And also, I'm helping investors just like yourself build their large property portfolios right here in Melbourne in some of the best suburbs. So, everything I'm sharing with you today is not just to educate you about what's happening in the economy and what's happening in the real estate market. I want to give you some practical insight and just some nuggets of wisdom that you can take on board and probably hopefully make some money out of the information that I'll be sharing with you today. Also, I want to thank you guys for buying my book that's got #1 bestseller again just before Christmas. I really want to thank you because I'm doing no marketing at all. It's purely organic growth. So for those who bought my book and my finance books, thank you very much. I really appreciate your support, guys. It's a humbling experience. By the way, if you want to get a copy of my book on real estate investing made simple, go onto realestateMadeSimple.com.au, and the finance book, which teaches you how to smash your mortgage in record time, jump onto bookonfinance.com.au. That's enough of the shameless plugs. By the way, you get it also, just because you're here is because it's Christmas is coming up. You're more than welcome to access my online video course, which is valued at $497, absolutely free. Just scroll down below. There's a link there you can upload and you can start watching information and get educated on how to build and structure a large property portfolio that can create financial independence in your life. Now, let's talk about the market. So what's happening at the moment? Is it really important to know what's happening at the moment? Well, yes and no. I'm a big picture person, and to me, property investing has always been a long-term game, 10 years plus. Short-term, it's been a gamble, When people buy a property and want to sell it 12 months later, they're more gambling than investing in property. You're better off doing shares of crypto than real estate. Real estate can have moments and years or two where it can be really negative in terms of your capital growth potential. Melbourne's been decimated by Dan Andrews and the Labor Party since COVID-19. We're pretty much bankrupted. We've got $200 billion worth of debts. COVID-19 was a disaster for real estate. As you know, we were locked down more than any other city in the world. Businesses have gone bankrupt. Consumer confidence has plummeted to record low levels, similar to those during the GFC. So Melbourne's been an economic basket case, and Victoria for that reasoning since really COVID-19. So last 6 years, it's been a very difficult market. But during times of difficulty, what you can do, as long as you have the know-how, is you can pick up really good assets at distress level prices. And so what happens during economic downturns is more people make more money during economic downturns because there's a transfer of wealth that happens between the uneducated and the educated, and the money flows from the uneducated people to the educated people. Majority of the wealthiest people that I know make more money in a downturn than in an upward trending market. Now, it's hard to say that because a lot of people don't know what the hell I'm talking about and they've never seen examples of that. And I believe you. I just know people that have bought a lot of development sites during COVID and they've made hundreds of thousands of millions of dollars since then because they were buying stock that was distressed from banks where developers were failing, and they were buying really good sites in places like Hawthorne, Brighton, Doncaster, Templestowe, Moonee Ponds, Essendon, Yarraville, Port Melbourne. They were buying stock that was distressed because developers went bankrupt, and they were buying them. Literally, the agencies were closed. You couldn't even market projects correctly. They were paying cents in the dollar and then sitting on that stock, and now they're developing that stock right now. So always remember that the most successful investors make money at the bottom of the market, not at the top of the market. But you've got to have the skill set and education and psychology to understand exactly what to do. And this is the challenge that a lot of investors have. And this is part of the reason why I've got this YouTube channel, is to give you guys that insight onto what are some of my most successful property investors doing and what are my colleagues doing that are much more successful and wealthier than I am. If I want to share with you one distinction that has made me more money than anything else that I've ever learned in my whole 30 years of investing, is your network will determine your net wealth, but you want to be the poorest person in your network. I am by far the poorest person in my network. All my friends are multimillionaires with huge property portfolios, commercial, residential, industrial, with businesses that are making 10 to 100 times more than my business. And I'm by far the poorest, which is exactly what I want to be, because what happens is when you're playing with people that have a high game plan than you lift up your game plan. If you're the smartest person in your network, you're in trouble. Okay? If you're the richest person in your network and everyone is broke around you, you're in trouble because you can't learn, you can't grow in that network. So you've got to find people that are happy to hang out with you, which is really difficult because obviously, everyone wants to hang out with millionaires and successful people. And you want to be the poorest person in your network and they'll elevate you to the next level. That's been my number one secret of success over these years. And all my friends are much more successful than I am and much more proactive. And they implement a lot more than I do. By the time I wake up, they've probably done like 10 things. But that's exactly where you want to be. So what I want to do today with the December market update is not just go through the boring stats that everyone knows about auction clearing rates, vendor discounting, consumer sentiment index, interest rates, which is what you can get that from anyone. I want to give you some bit of an update of what's happening beyond that and how we can take advantage of the prevailing circumstances. The most important thing to understand about the property market, it's worth now $12 trillion, and there's only 2.5 trillion in outstanding mortgage debts. Despite all the doom and gloom, by all the negative people out there, and there's a bunch of economists that have come out right now saying the market's about to crash and the bubble's about to burst, which has been bursting for the last 30 years. You got to understand the debt to asset ratio in real estate is extremely low. It's 2.5 trillion of mortgage debt against $12 trillion of assets. Now, people will say, well, the assets are overinflated in their value. Compared to what? Like, what are you going to compare real estate to? It's basically Earth. God's not making more land, as you know. So the thing is, you want to be part of it, and you want to be part of it in a big way. You want to buy as much real estate as possible before it becomes impossible in Australia to own real estate. And at the moment, the debt income coverage ratio is such that it takes 11 years now on average for the average income earner in Australia to save a 20% deposit, which is pretty much a third of your working life career if you're working for 30 years after you get qualified. So it's becoming more and more prohibitive to enter the property market. That's why you got to be smart. I suspect the next 10 years could be the final decade where the average income earner still has an opportunity to get into the property market before we have a whole generation of renters out there. And the percentage of renters that have given up on the Australian dream of owning real estate and having a house on a big backyard is increasing every year. And I've done YouTube videos just on this topic, and it's going to become a norm. It's going to become like Germany and Europe, where 90% of people rent, and ownership is something your grandparents did, which is pretty sad because I don't know about you, but I grew up in the 80s, probably the best decade ever, and we spent all our time outside playing cricket and footy in the backyard. The only time I was inside was when I was bleeding, okay, or I had a piece of glass stuck in my leg and I needed to go inside. We were never indoors when I was growing up in the 80s. I was just out all day. Now kids are spending most of the time indoors, which is pretty sad. But going back to the Great Aussie Dream, that Great Aussie Dream, because the country is such a great country to live in, and there's so many people trying to get into the country, and we're all competing for specific areas, which are not all land is made equal, by the way. Proximity and geographic advantage is a huge thing when it comes to city employment and lifestyle centres. So people are competing for the same stock, and there's not much stock being created at the moment. There's a huge deficit of premium land and premium dwellings that are being available for people to live in Australia, and that's creating the upward pressure on Australian property prices, despite whatever else is happening internationally in all the different markets. So if you look at the 3-month average, Australia has appreciated 2.8%. And this kind of gives you the consumer pulse of what the market's going. Combined capital cities 2.9% and regionals 2.4%. Melbourne 1.6% capital growth from a very negative declining market into now going into slightly positive market, which is good. Melbourne is still the most undervalued major capital city in terms of value when it comes to opportunity costs, in my opinion. 12-month average, Australia has grown by 6.1%, which is pretty much all the markets combined. Capital cities 5.6 and regional towns 7.5. Regionals have done really well because they're very much affordable and they're very attractive to people. And I often say if I was on minimum income in Melbourne, I would probably move to Tassie or move to Bendigo. I wouldn't stay in Melbourne because Melbourne is getting very expensive. People are spending now 60% of their income just on mortgage, servicing their mortgage, which is insanity. So people are pretty much working their life just to pay off this one house, which they probably never pay off anyway, or they'll take 30 years to pay it off and then they're too old to do anything. So if you can't increase your income and if you're not going to invest, my advice is just to move out of Melbourne and go somewhere where you can spend your time enjoying life and having some kind of a affordable lifestyle rather than trying to fight in the Melbourne property market. I mean, in Sydney, it's even worse. Now you can't get anything under 1.5 million. I mean, garages are selling for 1.5 million in Sydney, so I don't even know why people live in Sydney. And there is an exodus of low-income earners from Sydney. And this is why regional centres are doing so well. Key regional centres, especially coastal towns, because they are giving people an opportunity to get their life back rather than just working and paying mortgages and paying bills. The capital cities is very cyclical at the moment. We went from a downturn in October and we're up. You can see all the major capital cities are slightly up. Does that mean anything? Well, it's at a macro level. But remember, property investing is always micro level. You can't invest in an index. You can only invest in a specific property. One of the things that the government has done, and the Labor government is just really known for boosting the market and everything they do tends to backfire in terms of affordability. Any kind of first home buyers investment scheme or grant or subsidy or any kind of scheme that helps people to get into the market ultimately backfires unintentionally and it increases the value of properties. And the best example of this has been the first home buyers scheme with the 5% deposit that was recently announced on the 1st of October. And look, every time historically, by the way, first home buyers grants or different schemes introduced by the governments have been implemented, the market had a boom because developers profit from this and they increase the price of projects and catering for this surge in the market. So you can see there, every time we had first home buyers grant in 2000, we had a boom. First home buyers grant in 2008, we had a massive boom. First home buyers grant in 2015, we had a boom. Every time you give free people money for free to people and decrease the amount of deposit you need or slash stamp duty, a particular segment of the market that's affected is going to have an instantaneous impact and it's going to surge. by, 5-10%, depending on what it is. So with the 5% deposit scheme, with no lenders, mortgage insurance, and no income limit, that has put massive pressure on certain segments of the property market. So it was capped in Melbourne to 950,000. In Sydney, it was 1.5, which is interesting. And there's been a lot of negative articles from experts, the industry experts, talking about how ignorant the Labor Party is by implementing this scheme, and how it's had an immediate impact on certain sectors of the property market, making them more unaffordable. Personally, I'm kind of 50-50 about this. I'm a Liberal supporter, but ever since I was from finished uni. But I can tell you now, I mean, it's not a bad idea, because a lot of people have almost given up on ownership of property in Australia. And to give someone the opportunity to buy a house for $950 using $40,000 all inclusive, I mean, that's a pretty good deal. I mean, if I was starting out again, if I was, in my first job in the first year, that's a really good proposal. So I actually like to think, and to me, it increased all my investors' property prices as well as my portfolio. So I don't know. I'm thinking of changing and becoming a Labor supporter, because every time they implement something, my property portfolio makes money. Ironically, all the biggest property booms we ever had in Australia were under the governance of the Labor Party, which is ironic, because the Labor Party should be against inflating property prices. They should be doing everything they can to make property prices more affordable, so that people can get into the market, which is very interesting. So once again, you can see the cap there. Melbourne and Geelong, 950, and Sydney was 1.5. You can't get anything in Sydney for 1.5 million anymore. It's ridiculous. In terms of the impact, if you look at Melbourne dwellings, all inclusive, value changes in October above the actual cap, above 950, was 0.8% growth for the month, and below was 1%. So there was about 0.2% difference in growth. For houses, same thing, 0.8% growth for the month for dwellings above the 950 price range, and then 1.1 for below. So there was a definite impact. The government was saying, oh, it's going to have an impact of 1%. Guys, it was 1% in 1 month. And this is the thing. And in Melbourne, it was 1.7% below. So it had an instant impact. Now, if you annualize that 1.7% times 12, you can see the impact. It was pretty much immediate. So obviously, it hit people hard. We were inundated at Investors Prime Real Estate. We didn't even deal with owner occupiers, but I had so many inquiries from first home buyers about buying townhouses under 950 off the plan, because off the plan you get the stamp duty concession as well as the first home buyer's grant with the 5% deposit. So we were inundated. Our phones were blowing up. And this is why I haven't done videos for the last few months, because I was so busy dealing with owner occupiers buying townhouses in prime areas of Melbourne. And I was doing every suburb, because when you're buying an owner occupied property, it's an emotional decision. It's not really driven by capital growth like an investor. So I was sourcing properties in Croydon, in Clayton. Carnegie was very popular. I was doing a lot of stuff on the other side of the city in Sunshine, Sunshine North, places like Braybrook, Footscray. First home buyers, affordable housing, mainly 3 and 4 bedroom townhouses under 950. And I told them, look, buy whatever you like, because people buy where they want to live for different reasons, mainly to do with work, schools, or family. And then for your second investment property, buy it with no emotion. You buy it purely just to make money. So just, and my company is a very boutique, small consulting company. We're a small fish in a big pond. If we were getting inundated with phone calls, I can't even imagine what happened in the market out there with the big players. And so the market basically, since October the 1st, blew up in Melbourne for properties under 950, and they all went up by $50,000 to $100,000, pretty much within 2 months. So if you bought a townhouse, a 3 bedroom townhouse in one of the many areas that I source for 950 or 850, in June, you would have made 50 to 100 grand, just because the first home buyers grant kicked in. And many of my developers, especially the smaller ones that do 1 or 2 projects a year, they sold out completely. And they've got no stock. So which is unfortunate, because people missed out on really good opportunities. And so the medium-sized developers did well, and the big developers that do, let's say, 600-700 bills per year, they sold a lot of their stock, but they had a lot of stock still available for clients. So in terms of the capital cities, you can see there for Sydney, we had growth of 2.3%. Melbourne is 1.6. This is for the month of October. We're always looking back at data, by the way. It's always a month old, roughly. And then you have ACT and the other major capital cities, which are counter-cyclical to Sydney, Melbourne, Brisbane, and Adelaide. In terms of Sydney capital growth, you can see that it went down a little bit in October, and it's going in 24, and then it's coming up a little bit, 0.7%. For the quarter, 2.3, and for the year, 4%. Melbourne it was down for a long time, almost 12 months. But remember, there's no such thing as Melbourne. Melbourne is 480 suburbs. We're talking about the accumulation of all the suburbs in Melbourne that were down. In October, we did 0.9%. For the quarter, 1.6, which is pretty healthy, 3.3 for the year. But remember, during Melbourne, if you look at, for example, this is from Domain for October, Heidelberg went up by 25.9%. Box Hill, I'm still seeing a lot of townhouses, huge trend of Box Hill South, 20% for this is annual change for the last 12 months, by the way, October to October. So October 24 to October 25. Oak Park, 18.2, Mont Albert, 16.5, Fairfield, 16.4, Canterbury, 15.6, Carlton North, great area, 12.4, Limbrook, wouldn't touch it, 12.3, Needry, fantastic, 11.8. Needry is actually really coming up well. Essendon and Mini Ponds have boomed. Same developers now that are developed. They've been traditionally only developing Essendon and Mini Ponds. For the first time, are going into Needry and creating a premium product. So I'm focusing on Needry next year. It's a sleeping suburb. No one really talks about it. It's undervalued, but you've got all the cafes and restaurants of Moonee Ponds and Essendon, but it's pretty suburban. And as I mentioned, for the first time, high-end developers are buying properties in Needry and creating a really boutique, amazing product. So watch that suburb in Melbourne. Carrum, 11.5. Flemington's always good, 11.3. Melton South, 11.1. Don't even drive through Melton South, guys. It's Baghdad. Ivanhoe, 10.7. Ivanhoe's a fantastic suburb. Burnside, 10.6. Brunswick West. Brunswick West is fine. It's just oversaturated now with townhouses and apartments. I'm not a fan of Brunswick West anymore. I was 10 years ago when it was cheap. It's expensive now when it's overbuilt, overdeveloped. You're never going to have issues there with rentals, but it is challenging. Meadow Heights, nothing suburb, 9.7. Pascoe South, fantastic. Pascoe South is a huge suburb that was on my radar for the last 3 years, 9.7. Frankston North, 9.6. Frankston North used to be probably the worst suburb in Melbourne. It was always between Broadmeadows, St Albans, and Frankston North. And I remember, if you watch my YouTube channel from 10 years ago, I was pushing Frankston North for blocks of land at 280 and 250. You can get a big block of land there. And now you can't get anything under 650. So it's tripled in the last 10 years. And it's really rough. Like it's not even like bad. It's the worst. But capital growth will happen. And eventually that undesirable element will be squeezed out of Frankston North, and they'll be pushed out into other suburbs because rentals are going to go up. With capital growth, remember, always the rentals get dragged up. So it's unsustainable. Even if a suburb has low income demographics and high crime, as long as it's got the right location and the right ingredients, which I can't cover today because that's like a whole hour, eventually capital growth will drag up the rentals with it. And eventually those people on low incomes will exit those suburbs and new people will come in with high incomes. High demographics have lower rates of crime and more stability, obviously. Aspendale Gardens, 9.2. And Melton West, 9.1. Melton West is just very affordable. Like, once again, never invest in Melton or Melton West or Sunbury or any of those suburbs. Nothing will ever happen there. It's an owner-occupied area with large houses, very cheap, but it's not an area that I would ever target for investment. And you can see there what's happening in terms of RBA. We've had inflation at record high levels, mainly because new house dwellings now make up 20% of the index, and because of the various constraints in supply chains. Materials from China have gone through the roof. Just steel and timber and materials have gone through the roof, and petrol has gone through the roof. This is why inflation has gone up so much, and the RBA rate cuts have stopped. And so, because obviously they don't want to fuel inflation even further. So the rate cut never happened for December, and I don't think there's going to be many rate cuts early next year either. So we could have maybe seen the end of the rate cuts. I think long term there'll be more rate cuts, but we've got to stabilize inflation first, which is quite interesting. So in terms of, like, if you look at September quarter, and we haven't got the December quarter yet, in terms of where the capital growth is, Melbourne is very fragmented. So just saying Melbourne's doing 4 or 5%, what does it really mean? It doesn't mean much, because if you look at Melbourne, and this is September 25 to September 24, and remember, so a lot of properties take 3 months to settle. So we're always looking back at data, because if it's December now and someone sold a property in November, that property hasn't even settled yet, and it's not in the system. So the most accurate data we have as property investors and real estate agents is 3 months old, really. So we're always looking back at the market where we were, because we've got to capture sales, and sales take a long time. Most real estate, agents, buyers, advocates won't do anything with less than 45 days settlement unless it's cash. But if there's a loan involved, most mortgage brokers like 60 days as a minimum, and 90 days is very common. So if you look at September quarter for Melbourne, I just want to show you how fragmented the Melbourne property market is, because people have this misconstrued idea that there is a Melbourne property market that's uniform, that does the same thing. It doesn't at all. So if you look at Melbourne Northeast, median price in September 24, 780. In September 25, 817, went up by 4.8%. Melbourne Northwest went up by 6.2%. Mornington Peninsula, which I don't even know how that's Melbourne, but it's 5.3. Melbourne West, 3.3. Melbourne Southeast, which is where I'm pretty much sourcing, went up by 5.2, which is fantastic. Inner East, negative 0.2. Outer East, 3.7. Inner South, which is fantastic, 5.3. And Inner, 4.4. So you can have a variance there of northwest of 6.2 right down to inner east of 0.2%. So you can see the variance of capital growth. So just because Melbourne's doing something, you've got to look at micro level, suburb level of what it's doing. These kind of updates, which are very popular on the YouTube, everyone's doing them now. They're very much just to give you the pulse of the market. They're not there to. I wouldn't make any investment decisions based on what Melbourne's doing. Melbourne's up, and people do, which is crazy, because within a rising market, there's many suburbs that are going down, and with a market that's going up, there's many suburbs that are going up, down, and sideways. It really depends on the area, what's happening. Brisbane, by the way, so it's boomed 10.8%. Now it went down a little bit. Now it's coming back up again. Adelaide, no one cares. No one cares. I'm kidding. Adelaide is actually doing quite well. You can see that South Australia had 10.34% for 12 months. Metro Adelaide 8.94. I joke about Adelaide on my YouTube videos, because I wouldn't invest in Adelaide, but it's actually the most well-planned city in Australia. And like if you look at it's got a park. It's so well planned as a city. There's just not much population pressure there, and the reason it's doing well now is because it was so cheap to start off with. And people are moving there because they're seeking just more better value for money. But the jobs are not there. The infrastructure is not really there. And this is just catching up to something that should have happened 10 years ago. Metro Adelaide 8.94, Central Metro 8.85, Outer Metro, in the Metro 8.62, Outer Metro 9.81, Metro Adelaide 12.71. So, and also, major towns around Adelaide, 12.79. You can make money in any market. You just have to have specialized knowledge. Perth went down. Now it's coming back up again in October, 1.9% for the quarter, 5.4 for the year, 9.4. Hobart went up a lot, especially after COVID. It was such a great area to move into. And then people left Hobart. A lot of people just came back to Melbourne and Sydney, because it's a very different city. I quite like Hobart, and I think it's an amazing city. but there's only so much pressure that market can handle. It's a very small market there. And so people went there, they moved, and they came back to Melbourne and Sydney. So the market went down, had a correction. Now it's going sideways pretty much. Darwin's booming. Darwin's very much dependent on the mining sector and different sectors. It's a very complex market, not something that I would recommend investing in. Even it's 15.4%, it can come down very hard as well. Canberra, 3.2. Sales and listings. And so listings, this is very interesting because in Melbourne, listings are down, say, 10% for the average year. But the volume of listings in some suburbs are 40% lower now than they were 10 years ago. And some suburbs in Melbourne are 50 and 60% lower in listings than they were 10 years ago, like Eltham and St. Helena, for example. There are suburbs in Melbourne now where people are taking up to 17 to 19 years on average to sell a house. So there are pockets and communities, Donvale, Park Orchards, Mount Eliza, where people have big houses, they're wealthy, they're well-to-do, they're kind of middle class to upper middle class. They've got great schools, no crime, no undesirable people, let's call it politically correct. And they kind of form a community and they stay there and they just don't upgrade. And so there's suburbs in Melbourne where people just refuse to move out of. And they've got record low levels of stock, and the stock that does come up on the market attracts a premium price because you have high income earners fighting over that stock. So in terms of like, if you look at the last 12 months, national sales, 2.5%, combined capital cities 1.1, combined regionals 5.1. Melbourne is 8.8. Sales activity is once again trending higher, with Cotality estimating 48,764 sales nationally through October. The regions have seen a steady uptick in annual sales activity, with rolling 12-month estimate 5.1 compared to this same time last year, 1.6% higher from the previous 5 years percentage. Meanwhile, capital city sales counts are up only marginally 1.1, with levels seen in last year 1.1 and 6.1 higher than the average. Median days on the market, this is something that I watch. In Melbourne in October 25, the average house took 30 days to sell. Now in October, and sorry, and now in October 24, it's 35. So it now takes 5 days less time to sell a property. So properties are selling quicker. The market is recovering, consumer sentiment's back. The auction clear rates are slowly creeping back up to normal levels, but we still have a long way to go. Vendor discounting is low, an average, negative 3.3 and 3.6. So you can see the vendor discounting is getting slightly smaller, which means people are not discounting. And a lot of properties that are getting passed in at auction are not selling at record low levels. They're still holding their reserves. They're still holding and sticking to the guns because they know what they have. So vendor discounting is a very good indicator of what the sentiment feels, what's happening in the market. By the way, if you look at the listings, and this is what I talked about before, listings are becoming lower and lower, and the market's only open from January, end of January to end of November. December and January, the market's virtually non-existent. But what I'm seeing is not across every suburb, because there are suburbs in Melbourne like Pakenham and Berwick, the fringe suburbs, they're booming and they have endless supply of stock entering the market. But these pockets in Melbourne that are very desirable, they're becoming less and less stock is becoming available. Another area is McKinnon, Ormond, for example. Like you look at Ormond on realestate.com, how many houses are in Ormond? It's probably 5 or 10. You look at Point Cook and Trigonina, there'll be 250. So there's a lot of suburbs in Melbourne where people just refuse to move out of, and that's not going to change. It's going to increase even more so. And eventually there'll be suburbs where there'll be one house on the market or two that weekend, and that's it. And I can see that happening with places like Hawthorn, Canterbury, Surrey Hills, Mont Albert North, places like that have very unique character. They're very leafy. They're very upmarket. People have a lot of money there, and they just don't want to sell. They don't need to sell, number one, where they don't get forced to sell like other people in low-income areas. So they can hold all their properties during COVID, during recessions, but they just choose not to sell because the areas are just so attractive, and there's nowhere to upgrade. And that's the other thing. Balmoral is another area, very tightly held. Weekly auction clear rates, you can see there, we're kind of slowly creeping up in Melbourne, from low 60s to mid 60s, but it's still a long way to go. The rental market, I mean, it just boomed in 2021. We saw 10, 15, 20% increases in rentals. They went through the roof. But remember what happens with rentals, guys? They shot up, and eventually capital growth comes up, and the rental yield as a ratio or a percentage gets equalized and goes down. So there's an inverse relation between capital growth and rental yields. The higher the capital growth, the lower the rental yield initially, and then the rental yield comes up. So you never get a situation where you're going to get 10% rental yield. You will if you wait 10 years, because the property will double in value and your rent will be a percentage of the property value. But where people get in trouble is they seek out areas with 4%, 5% rental yield, and they will never find them, because the moment it hits 4.5, capital growth shoots up, and then the area goes from, a million to 1.2, and the rental yield drops. So rental yields are very important for your portfolio, for your ability to buy multiple properties, but you've got to understand how they work. They're a cycle, and they're very counter-cyclical to growth cycles. And so your timing of when you're targeting areas is very important when it comes to rental yield cycles. I do a whole thing in my courses about rental yield cycles, because ultimately cash flow is the determining factor of how many properties you'll be able to buy over your lifetime. So that's a very important thing. So rental yields combined, Australia 3.6%, which means it had a good growth. It will stop at 4.5, and once it hits 4.5, capital growth will happen again, and then 4.5 will drop down. Capital cities 3.4, and combined regional centres 4.3, which is really cool. Dwelling approvals of record low. We're kind of short about 100,000 homes per year, and some states up to 150,000 homes, based on the amount of migration that's coming into the country. Labor has invited too many people to the country. I'm a migrant myself. I'm pro-migration. We came from Poland in '85. We escaped communism. So I understand, everyone wants a better life. And a lot of my friends are Eastern European, Russian, Polish, all different countries, and they also came as migrants. So I'm pro-migration. Okay, so don't send me emails. But I don't think we should allow millions of people into the country without having the infrastructure to support them. I think what we should do is build the infrastructure, hospitals, schools, transport, even estates, functioning estates, especially transport, which is very expensive to build. And then once it's built perfectly, we can have more people come in so they can enjoy the same quality of lifestyle as others enjoy in established suburbs. I think the biggest mistake the Labor government has made, and I understand why, that is buying votes, is allow more people into the country, into the major capital cities like Melbourne, than we can actually cater for. And this is the thing that I think is really, everyone's paying for it. The roads are congested. You can't see a doctor. People are disadvantaged. They're spending an hour in traffic every day or two to get to work. All those kind of factors. So definitely, in terms of capital growth potential, you got to target areas where there's a restricted amount of stock and people fighting over that stock, because that area has unique advantages geographically to the city, schools, transport, water, etc. Finance and lending, where investors are back in record numbers now, and you can see like there's a lot of investors that are hungry for getting back into the property market. Last 12 months has been We've been inundated with investors buying a second, third, fourth, a lot of refinancing, and obviously first home buyers up to the 950 mark. But investors especially, the total number of new investment loans rose 1.4 over the quarter to 32.9 billion, up 6.9 over the year. Investors continue to make up an elevated share of both total loan volume, 37.6%, and the loan volume is 37.7 relative to historic averages. This is particularly true in markets like WA, NT, and Queensland, with investors potentially chasing capital gains in these recent overperforming markets. You can see that in Melbourne, in Victoria, 31.3% of all loans were done by investors. And in some suburbs, it's as high as 40 and 45%. If you look at St Kilda, Carlton, for example, Fitzroy, areas like Richmond, Yarraville, Thomastown, premium investment areas, you can see up to 45% of loans written to investors rather than owner occupiers. So investors are definitely back. They've been back for 12 months. The bottom of the market was about a year and a half ago. It's only going to get stronger and stronger. I don't think we're going to go back to those previous levels. So if you're someone that wants to time the market, you've missed the timing. I don't think it's going to go back there. It's only going to go up and get more expensive in the future in specific suburbs, not everywhere. First home buyers in Victoria represent 34.1%. And they're also obviously peaked because on the 1st of October, we had the 5% first home buyer deposit scheme introduced with no LMI and no income assessment, which is really cool. In terms of in terms of inflation and interest rates, I think we maybe have seen the end of the cutting rate cycle for now. There's too many variables. No one knows what's going to happen in the future. The most important thing is that you've just got to watch the market and take advantage of the prevailing circumstances. If you came to my live event in 2020 and 21, when interest rates were 0.1%, Stephen McClutchy and I were telling people to fix their rates for 5 to 10 years. That's right, you can fix your rate for up to 10 years in Australia, and you can actually go wholesale. If you know where to go through private banking, you can potentially get up to 15 years, but 10 years is easy. They don't advertise 10 years, they only advertise up to 5 years. But if you go to the private section of each bank, business banking or private wealth, you can get up to 10 years fixed rates. So a lot of my clients that were very tight on serviceability, in October, November 20 to end of 21, I was really pushing them into fixing at least 50% or 100% of their loans on everything, including their home. And let me tell you, we hit the bottom of the market. I told everyone there's no chance it's going to go to zero, and I was correct because there was no need to go to zero. 0.1 was the lowest, and people getting 2.5, 3%, fixed rates for 5 and 10 years, which is incredible. So if you're one of those lucky people, you cleaned up, you picked the market really well, and if you were lucky enough to spend some time with me and my experts, we were telling people to do it. And I was jokingly saying, if I get it wrong, sue me. And no one did, obviously, because I was right. Dwelling approvals are record low. They're way below what we need to make in this country. I won't even read out the stats because we all know there's a critical shortage of new dwellings being built because of bureaucracy and red tape and the amount of taxes that make up the creation of a new house and land product. The other thing is a lot of people that are coming over from different countries don't want to live 100 k's from the city. They want to live close to work, close to the city, close to lifestyle centres and schools, etc. So, they're not creating any infill stock, even though they're talking about fast tracking things. The affordability factor is still a huge factor they can't get over, and I can't see it solved anytime soon. So, in terms of getting new stock to the market is going to be always challenging because Labor Party can create the incentives, but ultimately it's the private sector that needs to deliver future housing stock. And the private sector has been decimated by COVID with 7,000 building and development companies going bust over 2 years. And that segment has not recovered yet. And it doesn't seem like any politician or any governing party gives a crap about that sector. So there's a lot of developers and builders in Australia that went bankrupt during COVID-19. And a lot of people lost everything, their marriages, their houses, they've lost everything, and they have not recovered. A lot of them will never go back into that sector. A lot of tradies, electricians, plumbers, cabinet makers that were ripped off or have lost millions of dollars that was owed to them, left Victoria, went to Queensland. They've given up and they've changed industries as well. So it's one thing for the Labor Party just to say, hey, we need more houses. Yeah, we know. And here's a bunch of red tape we're going to cut and we're going to fast track redevelopment potential and zoning. That's cool. You still have to have someone to build it. You still need the builder and developer, the entrepreneur that can actually go and get the lending, make sure the numbers stack up and build the thing, because the Labor Party is not a builder. And you don't want them to be a builder. It will be the biggest disaster ever. I mean, these are career politicians. They can't run a chook raffle, so you don't want them involved in building a house. Their house wouldn't last very long. But I guess the final news is that the Australian real estate market is now above $12 trillion mark, and that's huge, which continues to outperform every other market long term. I remember it was $5 and $6 trillion. Go through my, in the last 10 years, it's virtually more than doubled, which is incredible. But if you look at once again, you can't invest in the Melbourne property market. If you look at, for example, this is Property Track Suburbs ranked 12 months median price, 12 months to July 25. So July 25, July 24, you can see all the capital growth. Aberfeldy, 24%, all the different suburbs that are going up at different amounts. Even like, Ports is kind of a holiday area. Dippity is great, 13%. Dingley Village, I wouldn't invest in. Fitzroy, 11%, So even though the market could be going sideways, down, negative, there are pockets in Melbourne and areas that are still doing double-digit growth. And this is why buyers advocates and sourcing specialists like myself, that's all we do for our clients is we identify those areas, despite what the market conditions are, and put our clients into those areas. You can make an absolute killing, guys, when the market's depressed or just humming along. You don't need to make money. Don't think you can always make money, only make money in the massive market that's booming, because that's the only option. Like we've seen markets that were flatlining, all the data, all these updates were negative, and people making $50,000, $100,000 in 12 months in capital growth. So if you're interested in learning more, by the way, I am starting to run my live events again from next year. I believe the first one is early next year. You can jump onto realestatefasttrack.com.au. These are 2-day educational events where you learn how to build, structure, and automate a large property portfolio from scratch that can replace your income. Stephen McCutcheon and I spend a lot of time talking about buying properties in trusts and how you can structure your property portfolio and how you can tap into a system that allows you to borrow a lot more money than if you're just borrowing money in your personal name. And we're going to show you all the hotspots, state by state, which areas are going up, which areas are going down. Also, we're going to show you how to identify your team of experts around you, and how to create a holistic plan where you can build a property portfolio in your spare time without requiring any of your weekends. There's nothing to fix. They're all brand new properties, and they can outsource virtually the whole thing to external consultants, including property managers. You don't want to be actively involved in investing, guys. You want to be passively involved, getting the money, getting the equity, but not doing much work, which is the optimum thing about investing. It's not an active strategy. So if you're interested in learning more about that, just jump on realestatefasttrack.com.au. Tickets are $47, plus you get a hard copy of my book, which is Australian Real Estate Investing Made Simple, which is pretty much the manual for the 2-day event that I'll be running. Also, some of you want to work with me one-on-one. I do. I'm a consultant. I work one-on-one with my clients. I'm a buyer's advocate and a property sourcing specialist. So if you do want to book in a strategy session with myself, definitely just scan the QR code or just email me directly. In the 60-minute strategy session, I go through your current situation, work out where you are, where you want to be, and I develop a plan based on property acquisition, brand new property acquisition only. So if you're interested in doing subdivisions, developments, renovations, I don't do any of that stuff. I just teach really wealthy or time poor professionals how to buy a lot of properties passively and build up a large property portfolio that can replace their income without doing too much work. So this is the opposite of active investing. If you're an active investor, which is really cool, and you want to do renos and subdivisions, I can't help you. And remember, the most important thing about investing is if you fail to plan, you plan to fail. A lot of people waste so much time doing the right things, but the wrong way. They have the right psychology, they have the right intentions, but they buy the wrong properties in the wrong structures, and years later make no money. I will show you exactly the system that my clients use to make lots of money quickly. When I say quickly, over periods of years, with very little risk, but with complete automation. So it's very passive of what we teach. So in terms of the 1 hour consultation, it's free. There's no strings attached. I'll sit down with you. We can do it on Zoom. go through your current situation, and you walk away with a real plan. I'll also give you a personal introduction, if you need one, to my mortgage broker, my accountant, my property solicitor, conveyancer. I deal with multiple companies in Melbourne. So if you need a good financial planner, risk insurance specialist, whoever, I've got them all. I've been doing this for 30 years plus. If you want to have access to my developments as well, I can put you onto priority waiting lists. And the 2-day event, sorry, my strategy session also gives you access to people like Cameron Fisher from Changing Places Real Estate. He's a great property manager. Him and Vanessa look after a lot of my properties. Stephen McClutchy, $1 billion in settlements. Loans Australia, one of the best mortgage broking companies in Australia. James Blake from Brain Co, an accountant that understands property and that he's an investor himself. So you walk away with a real strategy, but you also walk away with the actual people that can put the strategy in place for you. So if you're interested, all you got to do is qualify. There's a minimum qualifying criteria. You have to have at least $700,000 purchasing ability. So if you're a single person, you're going to be on 95 grand plus 112,000 equity. If you're a couple, you're going to be on that 120, 140. Or just get a pre-approval for 700,000. I don't source anything under 700. Majority of my properties are around the $1 million, $1.2 million mark, which is like a normal townhouse now in Melbourne. There's nothing under 700. It's getting even harder at 800 to source anything because prices have gone up so much. So if you're interested in speaking to me one-on-one, just send me an email, conrad@investorsprime.com.au, or just scan the QR code and you can book in a time to see me and we can catch up and go through your situation. I hope you guys enjoyed this update. I know it was very brief and short, but it is what it is. Melbourne now is prime for capital growth. We are so undervalued that it's ridiculous. The median price in Melbourne is 1.1 million. Sydney's nearly $2 million. We're going to catch up not to 2 million, but we're going to go up to 1.3, 1.4 very quickly. But once again, not every area is going to do that. There are areas that are going to boom. There are suburbs that are going to go sideways. And there are suburbs that are going down in Melbourne in terms of capital growth potential. If you want to learn about that more, come and see me face to face or come to one of my live events. That's it, guys. This is Konrad Bobilak, and I'll see you on the inside.